All right, let's talk about RH, formerly Restoration Hardware. Their latest earnings report was a real head-scratcher. I mean, they missed big time on profit, but the stock, it rallied. So what in the world is going on here? Let's dig in and figure it out together.
So here's our game plan. We'll start with the headline numbers, then we'll peel back the layers to see what's driving them. After that, we'll look at management's big picture plan, how the market took all this news, and finally, I'll give you our take on what to look for next. Let's do this.
Okay, so Section 1, the Q3 snapshot. And really, the best way to describe this quarter is a tale of two tapes. You had one story on the top line and a completely different, much uglier one on the bottom line.
It's pretty straightforward when you break it down like this. On one hand, earnings per share, a big miss. But on the other hand, revenue, a beat. So yeah, they sold a lot of stuff, but they just didn't make as much money on it as Wall Street was hoping for.
And when you look at the actual numbers, wow, that earnings miss is pretty jarring. We're talking almost 20% below what analysts expected. That's not a small miss, that's a huge one. But then you look at revenue, it just barely squeaked by, but, and this is important, it was still up almost 9% from last year. And maybe the real silver lining here, they pulled in $83 million in free cash flow. That's a solid number.
Okay, so that's the what. Now for the why. Why was profitability so weak when they're obviously selling more and taking share? Let's get into the nitty-gritty.
Well, according to management, it really boiled down to two big things. First, they got hit with some old tariff expenses that finally caught up to them. Think of it like a bill coming due from way back. And second, that absolutely gorgeous new gallery they opened in Paris? Yeah, that was expensive. The startup costs were apparently a lot higher than they'd planned for, and that really squeezed the margins. And you have to remember the context here. CEO Gary Friedman didn't mince words on the earnings call. He basically said they're dealing with, quote, the worst housing market in almost 50 years. 50 years! So when you think about it, any growth at all in that kind of environment is, well, it's pretty remarkable.
But here's where the story gets interesting. Despite all those headwinds, they were actually running the business really well. Look at this, $83 million in free cash flow, and they're on track for $250 million for the year. Plus, they cut their inventory and paid down a good chunk of debt. This is what you call operational discipline. They're basically battening down the hatches and making the ship stronger to ride out this storm.
All right, so this all leads us to the heart of the bull case for RH. Management is basically telling Wall Street, hey, stop looking at this one quarter, you're missing the point. They are playing the long game here, and they want you to play it with them.
And to make his point, Friedman pulled out the classic Benjamin Graham quote. In the short run, the market is a voting machine, but in the long run, it is a weighing machine. The message is crystal clear, right? Right now, the market is voting based on a bad quarter, but Friedman is betting that in the long run, the weight of what they're building, the actual substance, is what will matter.
So what are they building exactly? Well, it's way more than just a furniture store. They're building a full-blown luxury ecosystem. Think about it. Massive, iconic galleries in the world's best cities, high-end restaurants that completely change the financial model, and a booming interior design business. It's a three-pronged attack on the luxury market.
And this idea of hospitality economics is absolutely brilliant. You know how for most retailers, rent is just this giant soul-crushing expense? Well, RH is flipping that on its head. They're putting in these amazing restaurants that people actually want to go to. And in some cases, the restaurant alone can make enough money to pay the rent for the entire building. The furniture gallery then becomes pure profit. It's a game changer.
Okay, let's recap. We've got a massive earnings miss. We've got the CEO talking about a historically awful housing market. You'd think the stock would have gotten absolutely hammered, right? I mean, that's what should happen, but that's not what happened at all.
And you have to understand, coming into this report, the stock was already in the doghouse. It had been crushed over the past year, down over 57% while the S&P was up. So let's just say expectations were pretty much on the floor.
And then this happened. Despite missing earnings by nearly 20%, the stock ripped higher by almost 6% the next day. And it wasn't on low volume either. People were buying. It was a complete surprise.
So this is the million-dollar question, isn't it? Why on earth did the stock rally? What did the market see that made them ignore that ugly headline number?
And it all comes back to that Graham quote. The market decided to be a weighing machine, not a voting machine. Investors looked right past the short-term noise, the tariffs, the startup costs, and they focused on the things that matter for the long run. Market share gains, tons of cash flow,
and a belief that management's big, bold vision is going to pay off.
Okay, so where do we go from here? What does all of this mean for the next earnings call and for the stock going forward? Let's get into our take.
Look, the path forward is really a tug of war. On the good side, you've got solid revenue growth that looks set to continue. But on the bad side, those margin pressures aren't going away anytime soon. So the big question for all of us is, how long will the market's patience last? Will investors keep buying the story if we get another big miss on earnings?
This whole situation sets up a really interesting kind of gutsy trade idea. The whole thesis is that in this terrible housing market, RH is one of the only companies strong enough to keep investing and growing. Weaker competitors, they're just trying to survive. So the trade is to go long RH and short a bunch of its smaller, weaker rivals. You're not betting on the market going up or down, you're just betting that RH will crush its competition.
So, putting it all together, where do we land? For us, it's a market perform rating. Don't get me wrong, the long-term story here is absolutely compelling, but there's just too much risk in the short term, with the housing market and the challenges of a massive global expansion to be pounding the table right now. We're happy to watch this one from the sidelines for a bit.
This is not financial advice.